All right. Thank you again for tuning into another edition of the Make It Happen Multifamily Monthly Webinar Series. My name is Lee Fjord. I'm the founder of Green Forest Capital, and today we're going to talk about recession-resistant returns, earning real estate cash flow without the landlord headaches, essentially investing passively in multifamily real estate syndications and why workforce B class apartments are the asset class that we choose to invest in. Fun fact, we are expanding into self-storage as well, but today we're here to talk about apartments. So let's go ahead and kick it off. All right. I love to be able to kick these webinars off with a little quote, and this is one that's really been gravitating or connecting with me most recently. And it's not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Uh, that is who survives. Those who are responsive to change. So if you want to survive and you want to thrive in today's world, whether you're a real estate investor or otherwise, if you're not diving into AI, if you're not utilizing technology to make yourself more efficient, please do so. It is going to be the difference maker between your inevitable success or inevitable stumbling. All right, a little bit about me. I do these webinars in order to be able to meet new friends. I want to meet new friends. I want to jump on a call with you. I want to learn about you. I want to learn about your investing journey and find out how I can help you take that to the next level. I started out as a property manager in 2012, became a broker at Marcus and Millichap. Was investing in smaller properties along the way while I was doing that. Then expanded into commercial multifamily in 2019. And now, so far to date, have owned over 1,230 apartments, and we're continuing to grow day in and day out. I have Green Forest Capital, my multifamily real estate syndication company, and then also Make It Happen Multifamily, which is the thought leadership platform that you found out about this webinar today about. All right, your capital. Is it actually safe invested in the places where you have it deployed to today? The stock market, it's unpredictable. You don't really know where it's going to go up or whether it's going to go down. I mean, and I have a finance degree. I studied, investing. I have invested in the stock market the majority of my life, even into my childhood. And it's unpredictable. You have zero control whatsoever. So my suggestion is that you incorporate real estate into your overall all-arching real estate investment portfolio. So that's what we're going to focus on. We're going to focus on incorporating real estate into your overall investing portfolio across the board. All right. So, what we've got some rough waters coming our way. I can tell. I think a lot of people believe it to be the case as well. And what happens to real estate in and specifically B class commercial multifamily housing during downturns. So. During a major downturn in the marketplace, stocks just, they do crazy things because they are traded based on emotion. People sell them because they're fearful of this or fearful of that. Bonds also carry that as well. And putting your money in your mattress just isn't a good idea. I mean, every day that you have cash sitting in the bank, it is becoming worth less and less and less. So keeping it as cash is just not really a good choice. So what choices do you have? Well, just to be clear, My suggestion isn't 100% real estate. It's to just, incorporate it in to even out those waves and that's why I believe real estate needs to be incorporated into every investor's portfolio. But not every real estate is the same, honestly. You've got, office, you've got class A apartments, you've got retail, workforce, when you see big news all over, all over the major news channels, like the real estate is crashing, the value of real there's a loan wall coming our way of expiring loans. And that's not necessarily always, or in many cases, they're lumping a lot of other asset classes together all at once. So, multi-tenant retail, shopping malls, strip centers, single tenant retail like Walgreens. Some are doing great, some are failing, and some are being drastically affected by the changes in our world and economy. And some will just always kind of be there, kicking. So the reason why, and what like so we chose B class like 2000 and newer multifamily properties. And I've got a perfect example here for you later in the slideshow. But what is a B class multifamily? It's older, but its effective use is still high. It's not someone who's living, hand to mouth. It's not someone who can barely get by. These are people who have, good jobs. They've got, but they aren't in a place in their lives where they're owning their own home yet. It's not luxury where you've got like flames coming out of the waterfall at the pool, or you've got like, DJ Pauly D playing, concerts at the pool area at your apartment complex. It's not $1 million gym or some, crazy place where you would feel like you're at some luxury gym. Um, this is also not distressed property. This is not, old 1960s properties that haven't been touched in, almost, and call it 60 years that still have 60-year-old roofs and 60-year-old heating and cooling systems and 60-year-old everything. So it's functional and affordable, and it's highly in demand. So it is where many people choose to move to and live in good times and in bad. And it also, hits at a price point that's lower than Class A, and that's where the resilience comes from. So people will always need a place to live, even in AI in the future. In every instance you can think of, people will always need a place to live. In a recession, people don't go on is they don't spend their money the same way that they would in other cases. Like if there's a huge recession happening, you people make sacrifices and they choose to not spend their money. But what they will have to do is they'll always have to have a roof over their head. And of course, still many people in the United States at least are not able to, go out and buy a home, especially not during a recession. So yeah, rent is the most important bill to pay because people will always have to have it. Uh, pillar two on why B class. Well, as budgets tighten down, people who are moving out of A class, they moved into B class apartments. So they actually the better quality tenants that we're actually always looking for gravitate more towards B class properties than A class. They're willing to give up those amenities in order to be able to still have a decent, nice place to live. So yes, we've seen it in many times of stress where occupancies in B class apartments actually grow during recessions. And when we, when we at one of our properties, the property we're going to talk about here in just a bit, Main Street apartments, those rents on a three-bed, two-bath apartment that have laundry are at 1275, well below what you could charge for a brand new construction apartment that's a three-bed, two-bath, 1,150 square foot apartment. You would have to rent that for, I mean, easily no, maybe 50% higher than that, just based on the cost to construct the building. And the third pillar is the amount of inventory is not increasing. They're not building any B class. They're very rarely are they building B class apartments, just new, regular old apartments. They're building A class. They're building either A class or they're building low income housing tax credit properties, one or the other. They're not building very many new B class apartments because the cost to build is the same as it is as A class or very close to it, and it's not incentivized like a tax credit property would be, and you don't get those rents. So as you would A or B. So, or the financial support that you receive from the tax credit properties. So people just don't build it. And our submarket where we are investing in our sub markets where we're investing have nearly zero new B class apartments. So we follow the demand drivers. That's what brought us to Main Street. This is the property that we bought back about a year ago now at this point. And we buy where unemployment and population create tenants, not where we hope they'll appear. We want to see a diverse economy. We want to see solid set of anchors. We've got the university, we've got the Air Force Base, we've got the largest hospital in three counties, major distribution and manufacturing employers and retail. Like people drive from, 30 miles away to get to the Walmart or the Lowe's in Warrensburg. And that's why we chose to buy Main Street and buy in Warrensburg, Missouri. All right. So this apartment is exactly what someone would downgrade to, and that's why we bought it. It's 64 units across 17 buildings, all three bed, two and a half bath, 1,100 square foot laundry units with laundry. And yes, we do allow tenants to have pets. And many of our students, I mean, these are everyday folks. This is a a young couple that had just recently graduated college, or this is still, some students who are, not brand new freshmen, but, maybe they're juniors or seniors or in grad school. We have many of the staff and the facility of the college that work there, as well as people who work at the supporting other businesses and the Air Force Base. Our business plan is pretty basic. We're going to do very light renovations to the remaining 43 units that weren't renovated by the previous owner and bring those all the way up to market and then just press on market. And while simultaneously, we have to keep occupancy high. We've maintained over 95% economic occupancy at this property for the last year since we bought it, which means, and where the money flows to the investors is once you surpass 90. That's really where the distributions can drastically grow. The demand has been so high in Warrensburg for housing, especially for our travel nurse, our midterm rental housing, that we have now just recently finished our third midterm rental here. You can see my backpack just sitting there on the bed. So this is a picture that I took of it right after it was completed. So yeah, one of these studios was previously renting by the seller at Midtown. It was being rented for $600 a month. And we rent these for $1,200 a month furnished with all utilities included. Basically, it ends up being an extra net of around $400 per month. we will have the entire cost of turning this unit and furnishing it paid back to us in the first year of having this as a midterm rental unit. So the demand is there. The university is growing. We've got the Air Force Base is growing. The medical center is growing. We've got amazing retail and other employers that are all supporting the local economy there in Warrensburg. Median household income is well into the mid 60s. Unemployment is low. Population is growing. I mean, this is where we want to be buying real estate. All right. In-place rents. So we have grown our in-place rents in the first year. We bought it in July of 2025. Rents were $1,121 on average across 64 units. And in the 1 year, we have grown by 8.5% in just 1 year. And that doesn't even take into consideration the added additional revenue streams, which we'll talk about as well. But our market rate rents are 13.75. So we still have another $160 of growth, $159 worth of additional gap between our market rate rents and where we sit even today. All right. Our other way of increasing the value and executing our business plan at Main Street Apartment has been adding second and additional income streams. So when we bought the property, we had $1,400 a month of income at takeover. And now today we have over $5,500 per month in monthly auxiliary income. The vast majority of that is coming from our cable contract that has added an additional 4,100 approximately. Okay, sorry, the biggest driver is the internet program, which is actually $2,550 of that 4,000. So not only have we raised other revenue or other income items, but we've executed the process of adding a bulk cable program, and that has increased our monthly revenue drastically. So, I mean, that's just an extra $50,000 a year in added revenue. At a, I mean, not that it's a five cap, but at a five cap, that'd be worth $1 million. And that did not cost us anything. We bought this property for $7 million. So it's probably about 700,000. So this move alone increased the value of our property by 10%, most likely. About 700 grand would be my bet. All right. What does this look like for you? So our investors provided $2.2 million in equity. My partners and I, of that 2 million, put in $550,000. So we went out and raised 1.4 million from private investors just like yourself. That carried with it an 8% preferred return and a 60/40 GP split. The minimum investment was 40,000. And we started out with the plan in the first year of distributing only 6% on that 2 million. And we actually paid over that. So we've actually paid over and above the initial projected 6% return. We've actually hit our full 8% preferred return distribution on this property because it's been running so well, because the amount of capex that the property has taken was so low. Yeah, it's really just gone fantastically well. And our long-term plan is a projected internal rate of return of 21%, average annual return of over 19, and an equity multiple of 2.9. So basically, over 10 years, we believe our investors will essentially 3x their money. So every 100,000 becomes 290,000 in over 10 years. One thing to take into consideration when we're talking about this process, another thing that we're doing and we like to do with our deals is we do mid deal refis, or like a something called a Shangri-La deal where you get all of your money back, or I like to consider it a giant burr. Like buy, renovate, rent, refinance, repeat. So the refinance, when we refinance, we will return. We project on this deal to somewhere between year 3 and year 5 to refinance the property and return 100% of the original investment back to the partners. Then we keep the property, get their money back, and we all continue to cash flow quarter over quarter for a total of 10 years, maybe even longer. All right, this is one of the hidden benefits and drastically affects those of you who are also that have passive income gains that you need to offset. And it really affects any of you who qualify as a real estate professional. So if you're a real estate professional, where you earn more than 50% of your income from real estate activities, then this really, really applies to you. So we utilize a cost segregation study to be able to spread, instead of depreciate our property over the course of a full 27 years, 27 and a half years. Instead, we get to be able to front load the depreciation or accelerate the depreciation and take large chunks of it in the beginning of the ownership period. And what the result is of that for Main Street specifically, for our investors, was a 59% depreciable event. So if they invested $100,000, they would have received a $59,000 paper loss through depreciation last year alone. So if you're a real estate professional and you had earned $59,000 last year and you had invested, $100,000 in this deal, then, on that 59,000, you would be able to defer that until we sell when eventually you do recapture. All right. Um, The asset class and the location are pivotal. The one other aspect, or the aspects that you always have to take into consideration, is the operations and the back of the house. So, fixed rate, long-term debt, that's all we've ever done. We've never done bridge loans. We've never done floating rate debt. I don't want to have something that's unpredictable in my business. I don't want that to potentially affect my investors. So we don't do that. So we're always, and then the next thing is creating your business plan. We underwrite and create our business plans in a very, very conservative approach. We try to keep take into consideration every aspect that could possibly come up during the ownership period and address it in our numbers and when we're building out the long-term 10-year plan of ownership for the deer. And we even are very conservative on our exit strategies as well. So we invest alongside our partners, our passive investors. We invested over 25% of the total invested capital into the deal just ourselves. We love this deal so much, and we also want to be side by side with our limited partners. This is the one of the most important aspects of this. Uh, having the ability to know and control where the money flows and where it is spent and how decisions are made are pivotal for us. We do in-house management for a large portion of our portfolio, and all of our deals going forward will be third party or will be in-house managed, vertically integrated. And that just brings so much more control. We generally run our self-managed deals at around a 40% expense ratio, and our third-party managed deals usually run at about 50 to 60% expense ratio. I still haven't quite figured out where they find a way to spend the extra money. And it's not on the management fee because we still have a management fee that we earn. But they just don't spend our money, your money, the same way that we spend our money, your money. Every single dollar matters. All right. Of course, it's nothing is perfect. There's no crystal ball either. The real estate is subject to market uncertainty, to physical loss, to economic loss from the change of, the economy. So real estate is not immune to risk. Um, there is no like perfect investment. But what I will say is that with long-term fixed interest rate debt and good solid operations through careful management of the property, as long as you are able to continue to make your debt service as well as pay for all of your your taxes, insurance, mortgage, and expenses, then time will be your saving grace in real estate. And selling in times of turmoil is never a good option. So it's not immune to risk, but it does generally perform well during recessions and does generally, and with careful operations, can thrive. All right. Uh, it's a steady place. It's predictable as far as, as long as you buy it in the right location, I know how to operate it, and you don't allow for things out of your control to be incorporated into your business plan, like floating rate debt or something along those lines. You should be able to sleep at night owning workforce housing, B class workforce housing. So, what's the next step? Well, I'd love to be able to have a conversation with you. This is why I do these webinars. I do them in order to be able to meet new friends and friends that could eventually turn into business partners and investors. So use the QR code to book a call with me. I would love to be able to meet you, hear about your journey so far, and find out how we can work together. That is my honest goal. All right, I'm going to open it up to the audience. Any questions? It's a pretty small room today, so I doubt I'm going to get many. Anybody? No? Okay. Well, uh, once again, scan the QR code. I would love to be able to book a call and meet you over Zoom. And you can always find me at greenforestcapital.com. And always feel free to reach out anytime. I look forward to hearing from you and getting to know you. I hope you have a great evening. Thank you for listening, and I'll see you on our future meeting. Have a good night. Bye bye.